What is going on, everybody? Welcome back to Finance with Parks. In today's video, we're going to take you through a breakdown of home payments. What does our monthly mortgage look like? Take you through an example, how much you can kind of be expecting based on a home price. Also talk about how much should you be paying? What is kind of the going run rate of mortgage versus your take-home pay? And we'll also talk through the breakdown of what makes it up on a monthly basis. Let's get into it. Welcome back, everybody. If you're new to the channel, please consider subscribing. We talk about all things personal finance. And today's video, I'm going to share my screen a little bit and walk through a PowerPoint of what makes up a mortgage payment. There's 4 categories that we have broken down here. What is not included in that value, and then kind of my thoughts on, an overarching view of how much should it be as compared to your take-home pay to kind of give you an idea of what you should be looking for. So I'll flip over here to the PowerPoint. And before we get started, I think what inspired me to do this video is when you start looking for a home for the first time, people are like, oh, what's your budget? And I talked about this in the video on Monday, right? Well, I don't know, 300,000, 400,000, 500,000. If you're a first-time home buyer, those numbers don't really compute as well as, what is my monthly payment going to be? And so today we're going to break down on an example $325,000 house, kind of what could you expect monthly and how does that break out? So let's get into it. First one here is the mortgage, right? Mortgage, and we're calling that principal and interest. So let's say you buy the home for $300,000. That is going to be the principal amount that you owe on the value of the home. That's going to be kind of like your core payment, let's call it, right? Then the next part is going to be, well, if you don't have $300,000 in cash and you need to borrow that from the bank, they are going to charge you interest for borrowing. Now, the sad part is there are some times where the interest, right, could end up being like $200,000. The principal is $300,000 and you're almost paying double for the home value. So make sure when you first consider buying a home, you look at, they have like mortgage calculators or loan calculators, and it'll show you how much you'll pay in interest over time based on the amount that you're borrowing, how long the loan is for, and what kind of interest rate you're getting. So really look at that and it'll show you in a hurry, and it may surprise you, oh my gosh, I'm paying that much in interest. So on a $325,000 house overall with about $15,000 down, of course this is an example, has no relation whatsoever, then you would be looking about $1,350 for principal and interest. Okay, let's move down to the next one. Property tax. So property tax is going to be a little different depending on where you live. Now, there are a lot of great things about Texas, but one of the unfortunate sides is it is very high in property tax. And it also is kind of highly dependent on the area that you live in. It varies by county. So the certain area that we're in, the property tax, the certain area that this example is in is about $450 a month for property tax. Now keep in mind, let me flip back real quick. So keep in mind, the only item that you're really getting let's say a return for is the principal of your home. Because when you go to sell your house, right? If you bought it for $300,000 and you sell it for $400,000, your equity in the home, so to speak, or the difference that you get to keep would be that $100,000 in the sales price. So keep in mind, unfortunately, outside of the principal, you can call that like your investment, right? But the property taxes and a couple of the other examples we're about to go over, HOA fees, think of those as like additional fees or taxes, right? That you really don't get to see again. Those are items you're paying to other people that don't really count towards the equity you have in the home if you were to go and sell it. So I wanted to highlight that. But yes, property tax is what you're paying to the county. Now that helps pay for items like schools and roads and stuff like that. I don't pretend to know exactly what the property taxes are going towards, but that's revenue the counties are raising. All right, so then the next one, this is going to be homeowners associations, or also known as HOAs. Now, the area that we live in is a development. Now, let's say this area has a community. You have a community pool. You have a community yard area. You have maintenance, landscaping. An HOA fee will help An HOA fee goes towards paying for those items to have upkeep, gardeners, items like that. And so this also depends on the community that you live in. Some charge HOAs, others do not. In this certain example, this does have an HOA associated with it, and unfortunately it's $210 a month, which is pretty expensive. And like I said, it's not going towards your equity. So you really have to keep that in mind if your area has an HOA. One, you really need to figure out if they are charging an HOA, what are you getting out of it, and make sure you take advantage of those services. And two, is that going to be worth the trade-off? Are you willing to pay an extra $200 a month to live in a community that has an HOA? Also keep in mind, it can fluctuate substantially. I think $210 a month is expensive personally, but there are some people who are paying $400, $500 a month depending on the area, depending on the cost of living. So this can vary substantially. Okay, down to the next one. So homeowners insurance. Now this is gonna be required if borrowing money, and honestly I would recommend it 10 times out of 10 anyway, even if you're buying it with cash, and it actually might be required regardless. I'm not exactly sure, but homeowners insurance, right? You can go through any of the major insurance companies, State Farm, AAA, Farmers Insurance, items like that, right? But it would cover major damages to your home. If there was, you have to make sure you have a specific policy, right? But a tornado comes through and rips up your house, a fire, unfortunately burns down your home. These are items that homeowners insurance could cover depending on what kind of policy you take out. So for us, it's about $100 a month here, just rounded. And so that's another item, that's contributing to your monthly payment that you may not always think about associated on a monthly standpoint. All right, and then the last one that we have here is mortgage insurance, or PMI as it's also known, private mortgage insurance. And this is going to be essentially an additional fee that the bank will charge you if you don't put 20% down. Now, that's always the going target, right? Try to put down 20% of your home price. It helps you avoid paying PMI, but it also just gives you an idea that, the 20% down gives you the 20% down gives you a good idea that, one, you can afford the house, but two, you also get to avoid paying that extra fee to the bank. So unfortunately, in this scenario, this poor soul has to pay off PMI on a monthly basis, and it normally will go until you've paid 20% off on the principal. And unfortunately, because these loans are structured where you end up paying a lot of your interest up front, it's actually structured to have PMI in the loan 8 years until we reach that target, or until this person reaches that target. So just keep that in mind. If you can't come up with the 20%, yeah, $70 a month doesn't sound terrible right off the top, especially with all the other items that are already included on here. But in the long run, that can really add up in a hurry. I mean, you're talking about over $1,000 a year, almost $1,000 a year, just because you couldn't come up with the 20%. All right, so if we total all those up, we're looking at about $2180. So if we total all those up, we're looking at about a total of $2,180. And just as a target, I've seen a ton of stuff online. I tried to do some research before this video is, what do you suggest is affordable for monthly payment versus take-home pay? And a lot of them actually use calculating your monthly payment versus your gross pay, which would be, before taxes, before they take out items for 401ks, if you contribute to those. And I really don't like using that as a calculation, to be honest. You can do so, and that's totally fine. But the problem is, I don't think it gives you a good sense of how expensive it's really going to be on a monthly basis, because that's not what you're taking home in your paycheck. So in this example, think about it, right? If we're going to pay $2,180 a month for the house, and you're only bringing home $4,000, that's your take-home pay, right? Regardless of what your gross salary is, after taxes and stuff, you're taking home $4,000. 50% of that, that's really steep. I mean, you're going to be hurting from spending money anywhere else standpoint. And also remember that I just outlined, 4 specific items that are all, directly related to the house payment. But I have another slide. The next one, as you can see, I mean, there's other stuff that you have to pay for as far as utilities, and here we'll just skip to that slide. Electric, TV, water and trash, internet, gas. I mean, just right here alone, you're talking about another $250. So $21.80 for the mortgage, another $200 for this, you're at $23.80. Sure, you've got $1,600 left over to spend on everything, food, gas, restaurants. It's going to be very tight, long story short. So what I would recommend, and about where this example person is, is about 30% of the take-home pay. It's a comfortable level, in my opinion, to where you can still, in most scenarios, buy a house that doesn't require a ton of work. This obviously depends on the area you're in. But I think it's a comfortable standpoint to where, you're making a good investment in a valuable asset in the house, but it's also not dictating your entire financial spending. And you're not going to be having to stay at home eating bologna sandwiches, 7 days a week to be able to afford it. So this is obviously all opinion based. There's different ways you can get away with it. If you value your house more than you do spending other places, maybe you can bump it up to 40% of your take home pay. But this is kind of a good starting point where I would say, yeah, you will be comfortable and not have to stress about affording your monthly mortgage. All right, so that's all I had in today's video. I hope you really enjoyed this and it was informative. If you have any questions, please leave them down in the comments below. Just wanted to highlight, how this breaks down, because when we first started looking for a home, this was all kind of unknown for us, hadn't really understood how much property taxes were going to be, etc. So thanks again for watching. Remember to subscribe to the channel and like the video down below. And remember, finance is fun. See ya.